Thank you very much, Jonathan. Thank you to everyone who is online watching. This paper is on bank runs and is co-authored with Tobias Koenig, Carsten Müller, and Farzad Saidi. The motivation for the paper, as you can guess from the title, is on bank runs. We're trying to take the canonical financial and economic theories on bank runs to the data. And we know from theory that banks play a crucial role for the allocation of capital across the economy. Usually, the balance sheet structure of banks is such that it leads to maturity transformation and risks associated with that. Typically, loans on the asset side of conventional banks are very long term, but liabilities are usually shorter term. So this maturity transformation makes them prone to potential sudden liquidity disruptions, or what we call run events. The way we will be approaching quantification and measurement of this phenomena, we will be taking the macro historical view, which means that we will be looking at many countries and many years. There is a renewed interest in the topic since the 2023 regional banking crisis, the collapse of the run and collapse of the Silicon Valley Bank, and both policymakers and academics are looking at the question of bank runs with new data and new models. In the literature, in the macro historical literature, most most studies are looking at what are called bank crises or equity-driven declines, and also bank failures. Our focus will be on the liability side of bank balance sheets, and in particular on severe liability disruptions, also known as runs. Specifically in this paper, what do? We contribute two new data sets that we also make publicly available. The first one is a cross-country narrative chronology of bank runs. We cover over 180 countries, 200 years, and from more than 400 sources, we identify with the narrative approach more than 300 bank runs. Some of them are completely new events. Some of them overlap with some of the existing chronologies and papers and books that have been written on panics and crises elsewhere. Our second contribution is a new cross-country homogenized and harmonized database of bank deposits at the aggregate at the banking sector level of a particular country. This allows us to propose a quantitative measure of deteriorating conditions in the liability side of the banking sector. The deposit withdrawals measure that we construct is available for many countries, 179 over 200 years, and we collect the data from many different sources, including national central banks, newspapers, balance sheet data, and so forth. Our final data set is at the country and year level and includes some 13,500 observations. We emphasize throughout the paper the notion of systemicness. A systemic run in the paper will be defined as the intersection of the two data sets. That is a narrative run that takes place in the country and year at the same time as a deposit withdrawal. So in the intersection of the two sets, the narrative runs and deposit withdrawals is what we call a systemic run. The intuition is that a run could be on a financial intermediary or financial institution that is potentially not large or systemic in nature, It is idiosyncratic, in other words. So potentially that should not trigger a systematic policy response. But on the other hand, if we, at the aggregate level, if we can measure and we can witness a decline in aggregate deposit holdings in the same year and for the same country for which we observe a bank run, then that event is much more likely to be systemically important. We complement our country year level analysis with bank level data. And if I have time in the end, I will show you some of our results with bank level balance sheet information for the United States in two different eras. Let me provide an overview of some of the main findings. The first result that might seem simple is just to provide basic statistics and likelihoods of a bank run incident. For our models and for policy analysis, such a simple statistic as an unconditional probability of a bank run is super important for calibration, for policy prescription, for normative analysis, and so forth. We provide these numbers, and not just unconditional, but as well as conditional probabilities. For a narrative run, we find that across time and space, the unconditional likelihood of a narrative run is about 2%. It's about 47% conditional on the banking crisis, where a crisis, if you remember, is defined in terms of equity-driven declines. Since the probability is very low, 47% is far from 100, it means that runs and crises are going to be very distinct events, very distinct incidents, and I'll be showing you more on that throughout the presentation. We also provide various other probabilities, for instance, of an aggregate deposit outflow, which is around 12.5%. Importantly, the unconditional probability of a systemic bank run, it's also provided. It's around 1%. Again, the systemic run is a run that coincides with an aggregate deposit outflow. So these events are rare in nature. So you might say that, well, if they are so rare, maybe they're not macroeconomically important, if the likelihood is just 1%. Turns out, we really can look at systemic bank runs as financial disaster events that occur infrequently, but they have drastic macroeconomic implications. So we show that explicitly by documenting that the aftermath of systemic bank runs is several factors greater than the aftermath of non-systemic bank runs. So compare the long run impact on real GDP of 9% versus around 2%. Thus, runs that are accompanied by the aggregate deposit withdrawals are systematically and statistically have much larger effects on the real economy relative to runs that do not occur with deposit outflows, or non-systematic idiosyncratic runs are much less detrimental. So that constitutes the first important result of our paper, that it is really systemic bank runs that matter in the aggregate, not non-systemic. In addition to systemicness, we try to measure in the data what in theory is sometimes called this fundamentalness nature of bank runs. In the theoretical literature on the subject, runs are typically viewed as either events that are triggered by sunspots or behavioral phenomena, where individuals decide to run conditional on believing that someone else also running. So you have this failure of coordination and a complementarity between individual decision making. On the other hand, there is a long-lasting and powerful literature that says that no runs are driven by fundamental causes, such as considerations of solvency. So understanding empirically whether systemic bank runs are due to fundamental or non-fundamental causes is a first order question. So it's a very important question for the literature. So what we find is three pieces of evidence that support the view that fundamentalness is sufficient but not necessary for the macro effects of runs. First, we provide a narrative classification of every systemic run in our data into what we call fundamental and non-fundamental. A fundamental systemic run will be measured as a run that happens in a year of a country where we can clearly see some macroeconomic events that could trigger it. For example, a monetary policy contraction, a military incident, capital withdrawals, and exchange rate devaluation, and so forth. So we find that systemic runs are still contractionary, still they have negative effects on the real GDP, even when they're not triggered by such fundamental causes. So while fundamental bank runs matter, obviously, it's also important to take into consideration the textbook, the canonical Diamond-Dubovik runs that are driven by non-fundamental causes. So we also show that when systemic runs are not accompanied by banking crisis, or when they're not accompanied by banking failures, their negative effect on the real economy is still large and economically and statistically significant. Overall, these three pieces of evidence provide strong empirical support across many countries and many years that, again, fundamentalness is sufficient for the negative effects of runs on the economy, but they're not necessary. Even non-fundamental runs can occur, and they can have a negative effect on the economy, even when they're not triggered by underlying considerations of insolvency or other fundamental triggers. So this is a second key contribution of the paper. Well, we provide other auxiliary and supplementary pieces of analysis, such as we look at heterogeneous effects, whether capitalization of the banking sector acts as a cushioning buffer. We look at regulation, which could be interesting for policymakers. We distinguish between ex ante and ex post regulation. From the ex ante perspective, we find that the existence of a lender of last resort, an existence of a credible deposit insurance scheme, both act in a positive manner in terms of reducing the probability of a run turning systemic. So once again, existence of a central bank and the existence of a deposit insurance scheme reduces the probability of runs turning systemic, which is consistent with many theoretical contributions as well. In terms of ex post policy instruments, we have taken advantage of the fabulous metric and Schmelzing database of the universe of policy interventions during financial crisis, and we have found that liability guarantees are the only policy instrument that can help in terms of dampening the macro effects of systemic runs after they occur. So ex ante, there is quite a lot we can do in terms of reducing the probability of systemic runs events, but once they occur, conditional on a run taking place already, there's very little you can do, which is in line with our previous statements on the non-fundamental nature of some runs throughout history. Finally, for the bank level stage of the paper, we're studying reallocation of deposits across banks during systemic run events, and we try to identify at the micro, more granular level, which banks do households run on. And we, in line with theory, we find that households tend to run on high leverage banks. So households do understand that insolvency plays an important role, not just at the macro level, but also at the micro level. Okay, so measurement. How do we define narrative bank runs? We have a very strict definition, and that definition is as follows. Depositors rush to withdraw their deposits because they expect the bank to fail. So equipped with this definition, we read historical documents and we try to identify for each country and year in existence over the past 200 years, whether this particular definition could be applied to any given year. A bank is defined as any depository institution. At this stage, we do not discriminate between individual banks or clusters, banks of any size. So if we find there is a bank run in country X in a particular year, we assign a value of 1. So we count it as an event, regardless of whether it's at an individual bank level or a systemic contagion effect. We will use our quantitative data in the second step to distill the systemic nature of runs. Importantly, we're looking at retail deposits by households and non-financial firms only. And we make sure throughout the analysis that we do not double count events. We have numerous validation checks and readings by a team of people across countries. So this is an overview of the narrative chronology of bank runs in our paper, which is in the bottom 3 rows of this table, JKMS. And for comparison, we also present summary statistics of the 4 canonical and very famous data sets, Reinhardt and Rogov, Lavan and Valencia, Jordache Taylor, and Baron, Werner, and Schong. So as you can see, we have a very broad coverage of countries and years, lots of observations, and importantly, similarly in spirit to the BVX data, Baron, Werner, and Schong data, we combine the qualitative nature of the narrative identification approach with the quantitative nature of using hard data to improve your measurement. For us, that hard data is on deposit contractions, deposit holdings at the aggregate banking sector level. In BVX, the quantitative data that they're using in their analysis is measures of equity. For listed banks, they quantify the returns on equity and the values of equity for many countries. So in that sense, we complement BVX, but we differ quite significantly in terms of using a completely different quantitative data set. Our focus is not on equity declines, as I mentioned before, but on the liability side of the balance sheet, specifically on aggregate deposits. And conceptually, this focus has been, we're not the first to think of using deposits as a validation approach of runs or panics. This has been brought up many times in the literature by the likes of Gorton, Reinhardt and Rogov, and many others. Our contribution is to take the idea of using deposits as an empirical validation measure and take it to the macro-historical context from quite a few countries and many years. All right, so how do we measure the second key ingredient of our paper? The deposit withdrawals. So as mentioned previously, we focus on retail deposits by non-bank customers. We look at total deposits as well as demand and time whenever possible. For most of the time, we see total demand and time deposits, all 3 categories. We can look at nominal real deposits and without any implications for our results. We have we have taken the data from almost 50 sources. We have homogenized it and again made it publicly available. We exclude interbank deposits, the wholesale funding market, and it's something that that we're preparing for a separate project for a future paper. Finally, to compute frequencies, we also count withdrawals in consecutive years as a single episode in order not to overinflate our numbers. In order to compare our measures of narrative runs and deposit withdrawals with the existing literature, we construct what we call the unified measure of banking crisis. What we do is the following. We start with Baron, Werner, and Shaw, who also combine narrative evidence with quantitative data, as I mentioned previously. We look at their measure of banking crisis, and we add, in this order, Lavan Valencia, Jordan Shularik Taylor, and Reinhardt and Rogov. As a result, we have this banking crisis measure for every country and every year over the past 200 years that we can compare with our measure of bank runs, either systemic or not. So systemicness. As mentioned in the introduction, we emphasize the notion of systemicness quite strongly throughout the paper. We're motivated by several theoretical contributions, such as Ulik 2010, Diamond and Rajan, Amador and Bianchi, and the idea is quite intuitive that while individual bank level incidents could be not systemic in nature, if there is contagion, if there is a spread of or if a panic spreads across banks, there could be a cascade of runs, and liquidity disruptions will not be limited to just an individual institution, but the whole aggregate liquidity stock will drop. So the notion of a systemic run is very prevalent in the literature, and various papers independently arrive at more or less the same theoretical definition. And we take this idea to the data, and again we define a systemic run as an episode where we have narrative evidence that is also associated with an outflow of deposits from the banking sector. So to best visualize our measurement definition and contribution is to have this Venn diagram of narrative runs and deposit outflows as the intersection is our set of systemic bank runs. So how does our data look over time? Here we're plotting the frequency of bank runs that comes from our contribution. So the blue line with square markers is the frequency of narrative bank runs from our paper. And the red line with the circle marker is the unified banking crisis measure that is comprised of 4 other papers that I mentioned previously. Naturally, the crisis measure encompasses not just bank runs, but all kinds of financial crises and panics. So therefore, for most years, there are more crises than there are runs by construction. Very interestingly, while the trends and patterns are similar, they are not identical. So in a lot of years, we have more crises than runs, but in some episodes, like in the recent few years, we do have actually the opposite occurring. We have more runs and crises. The trends are very much in line with our existing empirical understanding of these decades. There is an increase in the frequency of runs up until the Second World War. The quiet 50s, 60s, and then the turbulent 80s, and with some uptick around the great financial crisis. And in recent years, although our data ends at 2022, but if extended to 2024, you would also see an increase in the frequency of runs due to the 2023 regional banking crisis. In the paper, we provide various decompositions of the time series and overall summary statistics for runs and crises across advanced and emerging economies, developed and undeveloped, with deep and shallow financial markets and so forth. For the sake of time, I will continue, but you're more than welcome to look those up in the paper. So we want to start thinking of how to unify our bank run narrative and deposit withdrawal data. So we want to validate that our deposit withdrawal data is actually capturing something meaningful. So we have two quick validation checks. On the left picture, we are plotting two densities, densities of deposit growth rates in normal times, that's the red dash line, and during bank run episodes. And you can see that during run episodes, the density of deposit growth rates shifts to the left quite substantially. That means that there are a lot more deposit withdrawals during runs that are identified with our approach. It's very important to emphasize that the narrative evidence and the deposit withdrawal data are completely independent. So none of these findings are mechanical because they come from completely two independent sets of measurements. On the right-hand side, we have an event study-like plot, which shows a significant decline in deposits around run events. So it's just to convince ourselves that our deposit data captures something related to liquidity disruptions, which intensify during run episodes. So theoretically, this is precisely what we're after. How likely are bank runs? I provided some benchmarks, some baseline probability values at the beginning. So the numbers that I quoted were the unconditional likelihood of a narrative run, deposit contraction, and a systemic run. But we're providing a whole set of conditional and unconditional likelihoods, not just for runs, but banking crisis, using our unified measure. And we hope that for theorists and for policymakers, these numbers will ease calibration and quantification of models. So what is the macroeconomic cost of systemic bank runs? Here I'm plotting for you results from standard textbook local projection methods, where we're looking at the impact of systemic runs on various macro outcomes. And we see a negative and significant, both economically and statistically speaking, impact of systemic runs on real GDP, real deposits, and real credit. So the impact on real GDP is around 9% 4 years after the shock. In terms of the magnitude, these magnitudes are large, but they are consistent with the existing literature. Existing papers on systemic banking crisis or panics, they all find the impacts on real GDP somewhere in that ballpark between 5 and 10%. In the important contribution of the paper is to really emphasize that it is systemic rather than non-systemic runs that matter. Here I'm plotting the impact of systemic runs, non-systemic runs, and deposit contractions without runs. So the blue line with square markers is what we have seen in the previous picture. That's the impact of systemic runs, which is twice or 3 times larger than the impact of runs that are not accompanied by deposit withdrawals. So again, the red line here, and on all the pictures, the red lines are bank runs that do not occur at the same time with a deposit contraction. Thus, they're not systemic. So non-systemic runs do have some macroeconomic effect, but after 4 years, they become almost insignificant, and they're much smaller systemic runs. So from the empirical, from the quantitative, and from the policy perspective, you can see the contribution and the importance of collecting quantitative data and uniting it with narrative data. So it's only the systemic runs that actually matter in the aggregate. The economic mechanism is real credit. So the bank lending channel or the bank lending role of the financial sector is visible here. If you look at the bottom right picture, real credit contracts massively after systemic run events. There is a liability disruption that is systemic in nature. Banks are forced to issue fewer loans, aggregate credit declines, and firms that are bank dependent, they receive less credit, they create fewer investment goods, and real GDP declines. So the classic bank lending channel of macroeconomic transmission is clearly in place here.
Rustam?
Yes.
Yes, we have a question from Tal.
Yeah, just asking
Tal,
if there's some measurement to the scale of the runs versus the size of the banking industry. I mean, it's hard to get the scale, the difference between the systemic run and the non-systemic run versus the size of the economy or the quantity of money. How impactful was that specific bank when there was a run on it?
So great question. So in the paper, we'll look at both the frequency and the impacts of systemic runs conditional on different sets of countries, such as large or small, developed or not, and also before and after the Great Depression. So very interestingly, we do not really find that the effects are systematically different. So there is obviously some heterogeneity, cross-country heterogeneity, and cross-era, cross-period heterogeneity, but that heterogeneity is not as big as you would think. So to answer your question, whether a country is developed or not, financially developed or not, large or small, the impact of systemic bank runs has very similar qualitative and quantitative effects. And if we can talk more after the presentation, or if you can also look at the paper or the website.
Thanks. Thank you.
Sure. So what have we established so far? We have established that runs are important for the macroeconomy as long as they're systemic in nature. But what about the origin of runs? What's the theoretical nature of bank runs? As mentioned in the introduction, the literature takes on two broad views. First, runs are driven by sunspot triggers, self-fulfilling prophecies. And the idea goes to the seminal Diamond and Dubovik paper and has been studied in great detail by many first generation and later generation papers. The alternative approach is to argue that runs are optimal events of individuals deciding to run on a bank even when nobody else is running. So individuals or agents are tracking fundamentals, and such as insolvency. They are rational agents, and they will run on whenever macro fundamentals are deteriorating. And the literature in this channel, in this direction, is equally as vast and as important. And of course, there are a lot of people and who believe that there is a place for both. There are some behavioral components to panics, the human element, if you will, but there are also the fundamental element. And there are papers such as Goldstein and Pausner, Bockel and Davis, and others who have built financial models and macroeconomic models where the banking sector is subject to both panic and fundamental-based runs. In terms of the data, it would be very useful for these class of models to know which channel is more dominant, or can we rule out one or the other, for example. So remember that we have identified quite a few systemic bank runs. What we now do is, for each event, we provide a narrative coding, which is also publicly available, which classifies every single systemic bank run event into a fundamental and a non-fundamental incident. A fundamental systemic run is a run that is accompanied by a clear sign of macroeconomic distress, such as a currency devaluation, a monetary policy shock, any type of financial or non-financial crisis. Out of 165 systemic bank run events, we found, according to our narrative coding, 55 to be non-fundamental. So around a third of systemic runs are non-fundamental. So clearly, fundamental runs are more frequent. But in terms of this is just a statement in terms of the likelihood. In terms of the elasticities of the economy with respect to these events, now we turn to that question next. So here we estimate the impact of systemic runs and non-fundamental systemic runs on the macroeconomy. And what we see is that the red lines that represent non-fundamental runs and the blue lines, which represent all runs, they're very close to each other. The impact on real GDP is not even statistically significantly different from the two cases. So while fundamental runs have a slightly larger effect on the macroeconomy, as you can tell by the gap between the blue and the red line for the real GDP plot. So while fundamentalness is clearly important and is sufficient for the negative effects of runs on the economy, they are by no means a necessary condition. So non-fundamental systemic runs, non-fundamental panics that are even less frequent in terms of occurrence throughout history, their macroeconomic impact is equally as potent as for the case of fundamental events. So in this regard, this plot and our paper provides a macrohistorical empirical support for the canonical idea in Diamond and Dubik, for the textbook prediction of that comes out directly from the paper. We supplement the narrative coding of systemic runs with additional pieces of evidence that does not rely on the narrative coding, but instead relies on more quantitative or hard pieces of evidence. Here we show the impact on real GDP and bank equity returns of systemic runs, banking crisis identified in terms of the declines in equity of banks that are listed, and the overlap of the two events. So clearly, if you have systemic runs, and at the same time you have declines in bank equity valuations, the impact on real GDP will be large. But even if you isolate runs from crisis, the impact, as seen from the blue line, will still be negative and significant. Interestingly, on the right plot, we see that systemic runs are not associated with significant declines in bank equity, while banking crises are by construction because they are equity-late events. So even if there is no measured and if there is no measured decline in valuation of the banking sector, there could still be a macroeconomic consequence of run events. Mostly because many banks throughout history and for many countries, they are not listed. So to conclude, equity-driven crises are sufficient but not necessary for macroeconomic effects of systemic runs. Similarly, we can look at our measure of systemic runs and the measures of bank failures from other papers, other datasets. And similarly, we find that systemic runs in isolation have a large negative effect on real GDP, a minimal effect on equity returns, while failures behave very differently. They also have a negative effect on real GDP, but a negative effect on equity returns. So the patterns of run-led crisis and equity-related crisis are very different. So policymakers should not just track bank equity, but also bank liabilities. Withdrawals of bank deposits is an early warning indicator or already an ex post indicator of a severe liability-driven crisis that is about to take place. So to conclude, the bank failures are sufficient but not necessary for the macro effects of systemic runs. So a few more slides before a couple of more slides before I conclude. So we'll also look at government policies, ex ante and ex post. In terms of ex ante instruments, we have looked at an array of possible institutional features that a country might have to prevent runs. The only ones that we found systematically works in terms of preventing runs are existence of a central bank and existence of deposit insurance with ex ante funding. That's also called credible deposit insurance. So if a nation has a credible deposit insurance or a lender of last resort, the probability of a run turning systemic is negative and statistically significant. In terms of ex post government interventions, the picture is a little bit more complex. We have looked at all of these ex post policy instruments: liability guarantees, nationalization, recapitalization, restructuring, bank holidays or deposit freezes, liquidity support, and we found that the aftermath of systemic runs can be tamed only with liability guarantees, as you can see from the first picture. That's a very intuitive finding because liability guarantees prevent the decline in deposit. They prevent and they stop withdrawals of deposits from the banking sector, which helps the banks to recover faster. And unfortunately, we didn't find any systematic evidence that any other ex post interventions help to temper the effects of runs. So while ex ante, there is a lot regulators can do to reduce the likelihood and the spread of systemic panics, ex post, there is less than we can do. Taking stock across space and time, we found that the macro effect of bank runs is large only if runs are systemic, that is accompanied by aggregate deposit withdrawals. Out of the 100 and so systemic bank runs that we have identified, we found that 33%, a third of them are non-fundamental, that is not driven by fundamental macroeconomic triggers and likely driven by sunspot-like behavioral drivers. We've shown through several pieces of evidence that fundamentalness is not a necessary condition for the macro impacts of systemic bank runs. The patterns of the evolutions of liability and equity-driven crises are very different. Equity declines and bank failures are not necessary conditions for the occurrences or impacts of systemic bank runs, and systemic runs can be alleviated ex post with liability guarantees and to some extent prevented ex ante with credible deposit insurance. And quickly get the time cue from Jonathan if I can. How much time do I have?
You have 10 minutes.
I have 10 minutes. Wonderful.
5-10 minutes. Yeah.
5-10 minutes. So I do have some time to go over bank level data. So most of our discussion in the paper is on the country time level of aggregation, but we do want to look at some granular data a little bit more. So what we do is we look at US banks for the recent era from 1976 and the US national banking era. And we're looking at the behavior of banks, individual banks, during systemic run episodes. So here we're looking at the national banking era, and we're plotting the distributions of deposit and loan growth rates during systemic versus non-systemic events. As you can see, for example, on the right plot here, during systemic runs, the distribution of deposit growth rates is substantially shifted downwards and to the left. So there is a reallocation. There is a reallocation of deposits across the banking sector, which is particularly more pronounced during systemic runs relative to other times. In other times, the mean growth rate is positive, while the mean growth rate during systemic run events is negative, and in particularly there is a lot of shift towards the left tail. Interestingly, in recent years, you can tell, to first order, you can think of as the recent era being after the creation of the deposit insurance scheme. So in the deposit insurance era, these reallocations are far less prevalent than in the national banking era. So suppose there is reallocation of deposits from certain types of banks to other types of banks. We want to really understand which characteristics are we talking about. So which banks experience deposit withdrawals? And we can look at, again, the national banking era first. So we find that banks that systematically are more likely to suffer from declines in deposits during run episodes are banks that are more leveraged, that are less profitable, and those with a higher core funding ratio, meaning they're more reliant on deposits. So less profitable banks, more deposit-relying banks, and banks that have high leverage ratios in the eyes of the agent, in the eyes of the household, are more likely to collapse, which of course, conditional on that, makes it optimal to withdraw your liquidity. So these characteristics, these patterns are sort of consistent with our theoretical understanding of bank level crisis. And similar patterns can be seen here for the recent data that comes from United States and US call reports. So again, high leverage, low profitability, and high deposit reliance are predictors of deposit withdrawals during systemic panic episodes. What about the aftermath? So banks that have these characteristics, that are in a bad fundamental condition during run events, they're more likely to suffer from a deposit withdrawal. So what happens to them afterwards? So here we can look at the impact around through an event study. We can look at the effects on banks with outflows and banks without outflows around the systemic bank run period. So importantly, we see here that the loan provision of banks with outflows is substantially lower. Interestingly, there is very little substitution or change in the structure of the liabilities. Liabilities fall by construction because we're looking at the differential effects on banks with and without outflows. So the story is pretty clear. Banks that have high risk and low profitability, more likely to suffer deposit outflows, and as a result, they're more likely to reduce their lending to firms. Firms will invest less, and the real GDP goes down. So so in this way we're identifying or crystallizing the economic mechanism of our macro findings, but really with bank level data instead. And similar patterns, very similar indeed, could be seen here for the recent decades for the U.S. call reports from 1976 until 2020. A much stronger decline in deposit outflows, much stronger deposit outflows in the treatment group, if you will, leading to a decline in loans for the treatment group, and that's the economic mechanism of the that we have emphasized throughout the paper, the lending channel. So we have also looked at the Silicon Valley Bank, and since we have looked at it, there have been other papers who have really zoomed in at the Silicon Valley Bank run and collapse with hourly, daily data. So I'm not going to spend too much on this. So if you're interested, you can look at the paper. And we have also provide many other macro case studies, such as the Great Depression in the United States and for many countries as well. And we're trying to understand if deposits are withdrawn, where does the money flow? Does the money in circulation, does the currency in circulation increase, for example? And this is what we typically find. So just to conclude, we have provided novel macrohistorical databases for many countries and many years. Our databases capture qualitative narratives of runs and quantitative deposit withdrawals. And we have new insights on systemicness and fundamentalness. For future work, we're now focusing on wholesale funding runs, something we're looking at, and also bank runs as financial disasters. And finally, before I stop, all our data is available at www.systemicbankruns.com. So once again, systemicbankruns.com, all our data is there online. Thank you very much.
Thank you very much, Rustam, for this fantastic presentation. So if the audience have any questions, please raise your hand and I will the floor to ask your question. So meantime, I would like to ask one question about identification. So how do you, I think you talked about that in the paper, but I just want to be sure, how do you handle the fact that some economic facts could lead to systemic bank runs or any banking crisis? I mean, the path you chose is to see how the bank runs affected the economics, but my question is more on the reverse causality. I mean, global question on identification.
Very good question. So in this literature, identification cannot be nailed down. With annual data, with country level data, there is very little you can do in terms of causality. So we have several steps, just like every other paper in the literature, we suffer from the same concerns, identification concerns. So we have taken some precautionary measures, both econometrically and also conceptually. Econometrically, we control for various lagged macro and financial indicators, but of course that doesn't kill the reverse causality concern. Conceptually, our emphasis on fundamental versus non-fundamental runs really helps with this idea as well. If we can relatively confidently claim that some runs are not driven by macro fundamentals through the narrative reading, so potentially we can argue that they are quote unquote exogenously assigned. Of course, that's to the extent that you believe the narrative identification approach of fundamental and non-fundamental runs. But again, all the way back to the Friedman and Schwartz and Reinhard Rogov. So in this literature, the main emphasis has always been and will always be on measurement, on the collection, measurement, validation, and understanding basic macrofinancial properties. But in terms of causality, we do not have an instrument, for example, for runs. That's something that could be done for future research.
Yes, sorry. Why not taking natural disasters or some exogenous shocks that you know there are exogenous are as instruments for bank runs?
Yes, there is a subset. So we have thought about that. That's a good question. There is a subset of runs that happen during unexpected military events such as invasions. So there are different wars that have triggered runs in a home country, but the invasion came. Then you have to argue that to what extent is this unexpected. So with natural disasters, that's a good one. So the people have written some. There are some studies, or not in this context, but they have utilized um, um, so floods or hurricane arrival. So that's something that we can do potentially in the future. That's yeah, but pushing on the pedal of causality is very complicated.
I see. Thank you very much. Do we have any questions from the audience? If no, I will continue. Okay, so feel free to raise your hand if you have any question about the paper or any questions related to another subject related to the paper. So I have another question, is more about how you define your bank run. It's a deposit side, it's a liability side, and on the bank balance sheet. Do you have any clue about the runs that could come from the asset side?
So yes, there are papers who have looked at sort of crisis and panics, paper by Calamares co-authors. So definitely you can have a situation where a banking sector suffers significant declines in terms of returns on loans, so makes backed investments. So that triggers liability disruption, and then so we try to sort of focus just on what we do. We wanted to keep throughout the paper real credit as a dependent variables. So you can see how it can become problematic if you have the origin of a run coming from a decline in credit, which causes liabilities to fall, and then you present results that causes a decline so you're going back and forth. But it's definitely something that people have taken seriously in other studies. Is just not the avenue we decided to go.
Okay, thank you very much. Yeah, I have other questions. Of course, it's a fantastic paper. So we have a question from Anton.
Thank you. Thank you, Jonathan, and thank you, Rustam, for this amazing presentation. I have a set of two questions on the same topic, on the legislative guarantees, which you said are the most effective way to prevent bank runs. From your data, can you define some character of a bank run after which the governments usually impose some kind of legislative guarantees to prevent future bank runs, like the depth of the bank run, or the coverage, systemicness. And the next question, do we move away from these guarantees once they are imposed, or do we in future come to the whole coverage of all countries and all systems with these guarantees? Because it's kind of a changes of the system of money in the whole. Thank you.
Very good. So on your first question, if I summarize this correctly, it falls under the category that of policy reactions and policy instruments being endogenous outcomes. So obviously the extensive margin of a provision of a certain instrument, that is whether you have or you don't have a liability guarantees, and also the intensive margin, that is the duration of the policy intervention, depends on the scale of a run and the macroeconomic condition. So here again, back to Jonathan's question, the causality here cannot be established. So there is this fantastic paper by Metrick and Schmelzing and the universe of policy interventions, but we don't know the counterfactual in a lot of situations where we cannot say how many runs or how many panics we have averted because of certain policy interventions. We don't know what the probability of runs would have been if a lot of countries didn't have deposit insurance now. And so in response to your point, which is a very deep one, if a run X takes place, we impose a liability guarantee and it's permanently imposed, or for a very long duration, naturally we can prevent other runs that could have happened in succession in the next few years. So that we don't know. So that we cannot say anything about. On the second point, so we have not done the intensive margin of liability guarantees. So we have only looked at whether a certain policy was enacted or not. We have not been able to look at so far the length, the duration, or what I call the intensive margin of the instrument. So that's something that we have heard before, and as well, and it's something that is in principle doable. So for instance, we say that liability guarantees work during panics, but maybe there is a particular characteristic to them that works even better. For how long should they last? How many years? How should they be communicated? Clearly, there could be some heterogeneous effects within the universe of possible liability guarantee implementations. So that's something we have not done, but we have thought potentially to include it in future versions of the paper.
Thank you very much. I have just one last question, if there is no question from the floor, from the audience, sorry. So it's more in terms of policy implications. Can we extract from your paper some, I don't know, maybe it's related also to the question from Anton, some more optimal deposit insurance design or something that could help the central bank to avoid these crises?
So there is a fantastic paper by Eduardo Davila and Itai Goldstein, Journal Political Economy, called the Optimal Design of Deposit Insurance. So there is a paper precisely written for this. Of your question, where do we come in? What can we say on this subject?
I'm talking about your paper.
Yeah. So for the optimal design of deposit insurance, you can write down a model where the optimal design will be a function of sufficient statistics, such as the likelihood of a systemic run times and the elasticity of the macro effects conditional on the run taking place. So ours is a measurement paper. So we have looked at the existing designs of optimal deposit insurance, which is clearly out of scope of our paper. So, and what the theorists say is that there is a set of sufficient statistics that needs to be measured. And again, those two statistics are the probability of an event times and the elasticity of on the macro elasticity condition on the event taking place. Both we have provided evidence for. So we know the frequency with which runs taking place. We know the severity of the macro effect when runs take place, but the particular design, the actual theoretical formula that you need depends on the model, and we cannot say anything more about that.
Put aside the theoretical optimal way, but just what could be for central banks the main takeaways from your paper?
Okay, that's a different. Now it's a different question. So
but it's related also to the deposit side of your paper. So.
Okay, because the reason you said optimal, so my brain went to
I know. Yeah. In general, this is the
case. Runs are much less likely to turn into systemic panics if you have deposit insurance. So there is a lot of noise and confidence bands are there, as I've shown you, but whether you have deposit insurance, incredible deposit insurance matters a lot. So credibility matters. You need to have credible limits and willingness to act upon it. If you have If your promise means nothing, obviously the agent will internalize it and we'll know what happens. So the runs are much less likely to turn systemic if you have credible deposit insurance. So that and also a lender of an independent lender of last resort. So the two institutions, they work across all countries and 200 years. So this is a robust empirical finding. And exposed liability.
So just to be clear, because it's very interesting for your paper and also the policy implications. So we need to state, I mean, in a credible way that we are, I mean, us, a central bank is the lender of last resort, and also to have deposit insurance, I mean, credible deposit insurances. These are the two main empirical findings from 2 centuries of bank runs.
Yeah, I would say for policymakers, these are the two.
Yeah.
We have looked at, you know, tens and if not hundreds of existing policy instruments that are available. So we're only emphasizing those that we found work. So we're not going to waste time with instruments that we found have very noisy zero effects. So yes, as you have summarized it perfectly, the existence of an independent central bank and also credible deposit insurance, which is correlated, but it's a completely different. So in a lot of countries, it's managed by a completely different authority.
Independent lender of last resort.
It depends. So it's a lender of last resort that is independent from political pressure, social So willingness to provide liquidity and create facilities independently of any pressure to the banks that are struggling to solve the liquidity withdrawal problem that is the nature of our systemic runs. And also and the deposit and the credible deposit insurance scheme, which is, you know, theoretically also absent some moral hazard problems, should reduce the willingness to run. And if you have a deposit insurance scheme, we do find that the willingness to run is lower. So to first order, it works. Yeah.
And your paper is one of the first, or if not the first, that shows this at such a long period of analysis and empirically.
Yeah, so I wouldn't claim that. I think that a lot of people have looked at that before. So our focus is on specifically runs, retail bank runs, accompanied by with deposit events. But for instance, Metric and Schmelzing has looked at a lot more situations and have more policies. So we're probably the first to look at the broad 200-year period. But there are hundreds of important contributions on the role of deposit insurance. And so clearly in the empirical banking literature, there's so many great papers.
Nice. So thank you very much, Rustam. It was a fantastic seminar, fantastic paper, dataset, and very nice empirical findings. Thank you for presenting this to us. And we wish you a lot of success with this paper and with the others that are in a nice pipeline of research. Thank you very much for being with us.
Thank you, Jonathan. Good to see you again. And thank you for everyone who is online.